You're scrolling through your feed, and suddenly, headlines start flooding in. Markets in freefall, AI-driven trading sparks chaos. Wall Street panic mode. Sounds dramatic, right? But here's the thing. It's not as far-fetched as it may sound. Artificial intelligence is transforming our world at a pace we've never seen before, from self-driving cars to smart home assistants to algorithmic trading that executes billions of dollars in orders in milliseconds. We celebrate AI for its efficiency, accuracy, and potential. But beneath all that hype, there's a question that's becoming louder and harder to ignore. Could AI be the very thing that triggers the next big market crash? Let's dive into this rabbit hole, because the answer is not as simple as yes or no. It's buried under layers of innovation, human psychology, economic systems, and technology we're still learning to understand. Artificial intelligence, at its core, is a tool. Like a knife, it can be used to cut vegetables or cause harm. The outcome depends on who's holding it and how it's being used. In the financial world, AI is like a scalpel cutting through data, dissecting trends, identifying patterns no human could ever notice. Trading firms use AI algorithms to automate decision-making, react to market changes instantly, and optimize investment strategies. These systems process massive volumes of data, speeds that make human traders look like they're stuck in slow motion. And that's a good thing, until it isn't. Let's rewind a little. In 2010, there was something called the flash crash. Within minutes, the US stock market plunged about $1 trillion in market value, only to rebound shortly after. The cause? Algorithmic trading gone rogue. While that incident didn't directly involve today's complex AI systems, it was a warning shot, a glimpse into what can happen when automation misfires in the financial system. Fast forward to today, and we're way past simple algorithms. We now have self-learning AI systems making high-frequency trades with minimal human oversight. They adapt, evolve, and even learn from one another, but with that power comes fragility. Imagine thousands of AI systems, each trained differently, analyzing the same data, trying to outwit one another, and making lightning-fast trades based on tiny market signals. One misinterpretation, one anomaly, one unforeseen event, and the dominoes start to fall. The scary part, humans won't see it coming. By the time we notice, it might be too late. AI doesn't panic, it doesn't get scared. But it also doesn't feel caution, intuition, or restraint. These are human qualities that often act as circuit breakers in times of market stress. Without them, we're left with machines chasing signals, feeding off each other's moves, and potentially escalating problems exponentially. Now, let's zoom out and talk about black box trading systems. These are AI models that even their creators don't fully understand. They work until they don't. Financial firms build these systems to outperform competitors, and they guard their methods like secrets in a spy novel. But when these systems fail or start interacting in unexpected ways, no one knows how to stop them. The opacity becomes the threat. And then there's herd behavior, not just among humans, but among machines too. AI systems are often trained on similar data, using similar techniques. When they all reach the same conclusion at the same time, say, to dump a stock or short a market, it's like a digital stampede. We've already seen instances where trading bots triggered massive sell-offs based on misinterpreted news headlines, tweet sentiment, or even false data. Now imagine that on a global scale. Let's talk about data poisoning. This is when bad actors intentionally feed corrupted or misleading data into AI systems. In the financial world, where trades are made in fractions of a second, even a small manipulation can be catastrophic. If someone figures out how to subtly poison the data streams that trading AIs rely on, they could potentially crash segments of the market or profit from the chaos. And it doesn't stop there. AI is increasingly involved in economic forecasting, risk modeling, credit assessments, and even corporate decision-making. That means its influence extends beyond the stock market and into the real economy. A glitch in one area can ripple through the entire financial system. So what's the solution? Do we shut it all down and go back to floor traders waving slips of paper? Of course not. AI is here to stay. It brings undeniable benefits: faster trades, better liquidity, and more efficient markets. But it also demands regulation, transparency, and accountability. Right now, the regulatory framework around AI in finance is like trying to catch lightning in a bottle. Technology evolves faster than lawmakers can respond. In many cases, regulators don't even fully understand how the systems they're supposed to oversee work. And financial institutions aren't eager to lift the veil, either. We need auditable AI models, systems that provide clear explanations for their decisions. We need real-time oversight tools that can flag anomalies before they snowball into disasters. We need global cooperation, because markets don't stop at borders and neither does AI. And let's not forget the human element. At the end of the day, someone builds these systems. Someone trains them, someone decides where to deploy them and how. Blaming AI for a crash is like blaming a car for an accident. It ignores the driver, the road conditions, the faulty brakes, and everything else. There's also a deeper, more philosophical question here. Have we become too reliant on systems we don't fully understand? In our pursuit of speed, efficiency, and profit, have we sacrificed resilience?